Let me pull back over the window here. Thanks, Mirza. Appreciate that. So welcome aboard, everybody. As always, we'll start with SPX here, kind of talk about what the market's attempting to do today. And then, of course, once again, this is a great time to where if you have any questions around the market, around the indexes, around indicators, anything at all, I am more than happy to answer those questions. We can really dive into them in the Simplers Essentials room and really give more time to answering them. We're not solely focused necessarily on finding trade setups. Though, of course, if you have a symbol that you want to look at, you want my 2 cents on it, I am also happy to do that as well. So just let me know. It's really a free for all for what you guys want to do. But starting with SPX this morning, we had a nice gap to the upside. Now, this to me isn't too surprising for those of you that are in the small account mentorship. We kind of talked about this possibility happening yesterday. And the reason why, of course, is because we had some bullish divergent bars on the hourly chart that were valid into the close. And so on SPX in particular, what we've noticed over the years trading this index is specifically when it has a bullish divergent bar. Usually on the divergent bar indicator, we look for the signal to follow through within 3 bars, right? And a lot of the time it does. For example, we had a bearish divergent bar at the open, and that immediately followed through with a lower low at the next bar. We had another bearish divergent bar into the close yesterday, and that one followed through on the last hourly bar, right? So usually you get that follow through to happen pretty quickly. But on the hourly chart specifically with SPX, we've also noticed that if a divergent bar doesn't follow through within the same day, or certainly within the 3-bar rule, or if it's like yesterday where we also get a divergent bar that prints right into the close, it's not uncommon to then get that follow through the next trading day. And so sometimes it can actually make for a great entry for a potential overnight trade. So if anyone had taken a bullish trade idea based off that analysis, right, then it worked out beautifully for you so far today. We had a nice gap to the upside, so that immediately followed through with the bullish divergent bar that printed into the close. And then that run up within the first hour also got this bullish divergent bar, which printed on the second hourly bar of yesterday, to follow through as well with that higher high, right? So that was a very nice follow through. And then we've continued to stair step up, though we are starting to get some stalling around this level, right? Our lower time frames are definitely at the top of the axis for momentum, so they could use a slight reset. Keep in mind when momentum resets, it doesn't necessarily need a strong pullback. It could just consolidate, and that could be a way for it to reset overall. From a slightly bigger picture point of view, right? When we zoom out here, it looks like SPX is trying to work its way up towards the 100 period simple that's currently at 44.50. So that could be ultimately a target to try and trade up to the upside there, and see if it can't get going for a move higher. So that's also a possibility. But I think the real question for today will come about on how this trades into the close, right? So currently we have a nice stair step up, but the real question is, can it maintain holding this level into the close, or do we get some selling that brings us back down, or some profit taking on the bull side that drops us back lower? And really what I would be looking for today into the close is, does SPX close above the 10 period simple, which we currently are right now, right? The 10 period simple is at 44.2192. Let's just call it 44.22 basically. So do we close above that level and try and turn resistance back into support? Or do we drop back down to where that level remains as resistance? And it wouldn't take too much of a drop, of course, from where we're currently trading at to get back below the 10 period simple. If the 10 period simple holds as resistance, then that gives a better probability that we still might roll back down to test the 43.50 range. If not, maybe go back to test the 100 period simple and find ourselves kind of in a wedge pattern, right? Where the 10 period simple holds as resistance and the 100 holds as support. But if we manage to break and hold above this, we could actually have found the pullback that we are looking for, and it engages us in another buy-in opportunity to stay long in the index. Now, overall, when we zoom out here, we know that the index itself for SPX is still more in consolidation, right? The 10 is in between the 30 and the 100 period simple. There is still bearish momentum with room for that to move lower. So we haven't gotten any green bars yet to help satisfy a possible reversal. We do have a bullish signal. This is a bullish pullback signal that might technically be satisfied already by the move up into the 10 today. But if we break above it and this remains valid, then it could be a clue that we're, trying to work our way back into 4,500. And then, of course, from a daily perspective, we have a bearish divergent bar. And so this, of course, is looking for that possibility of a lower low within the next 3 days, right? The next 3 bars. So that might still put some weight on a reversal going into the end of the week. Another thing that I think could affect the markets here, of course, is NVDA earnings. NVDA has earnings later today, right after market close. So I don't see any questions coming in from you guys. Let's spend the time then going through a potential earnings trade to walk through on NVDA. And we can see what that might look like. Because this is one earnings I wouldn't mind maybe participating some in. Let's see if it can load up here. So here's NVDA. We had a Right. So we have earnings coming up, like I mentioned, today after market close. And obviously, we had a bit of a pullback last week. Now, part of that was due to SMCI. So let's actually pull up SMCI here first. So SMCI here, their earnings announcement, we had a strong gap to the downside, right? They completely missed the ball, or, it really doesn't matter. What matters is the market reaction was very much negative. Negative to the downside, right? We were trading at 350, and then by the end of the day, we were basically close to that 250 level. So 100-point gap move lower. And of course, because of the company it was, right? It's similar to NVDA, to where NVDA kind of felt that pullback, right? And it too continued to trade lower to the downside. So the question here for us is, do we get a volatile earnings like that, right? Does NVDA end up making it a stronger move up or down, or do we start to, kind of stall here? And I'm going off the idea that we get a volatile move. Now, I don't know if I don't know if we'll necessarily get a big move, and I don't know if it will be up or down, but I would certainly not mind placing a trade idea around this to play off the probability that we do get some sort of volatility around the announcement, especially because it does kind of feel like some of the bigger names are kind of, the bigger tech names, if you will, are kind of eyeing NVDA to see how it reacts to its earnings announcement. At least that's what it feels like to me. And so as we get here into the announcement today, just taking a look at the charts itself, we do have some bullish sentiment, right? Momentum's attempting to cross above the zero line. We have bullish sentiment here. We have a squeeze. We also have a recent true low. So that, of course, if the earnings move goes off of what the technicals are currently telling us, that would have me think that we get a stronger bounce to the upside. But we've also seen before where earnings can completely contradict what the technicals are telling us, right? That's why it's an unknown event. A great example of this is with Dick's Sporting Goods the other day. Dick's Sporting Good was overall in a bullish trend as well. Had their earnings announcement come out, completely missed the mark as well, right? Disappointed the market on what they were talking about with future growth, how they were on their earnings. And it caused a strong pullback yesterday, which you'll see as soon as this chart loads up here. Taking a second. There we go. So here, of course, right, attempted to get into that bullish sentiment going into the announcement, and then completely faltered and broke to the downside. So this is why earnings, of course, this is a great example, I should say, of why earnings is so unpredictable, right? Anything can happen around the announcement, any sort of little nuance, whether it's in the actual numbers themselves or whether it's some future guidance that they give out, can completely shift the narrative of what the chart might be trying to tell us. So for NVDA, if I'm playing this off the possibility of getting a volatile move on earnings, I want to still participate in both directions of that idea, right? So the earnings trade that I'm going to walk through here that we'll price out together and see if it makes sense is something where I'll look to play both the call and put side. Now, downside to this trade idea, if nothing happens on NVDA, right? If it's a non-event, if NVDA is kind of already priced in the move, nothing too dramatic happens with the numbers or with their guidance to really make the market want to move it, it could remain flat. And if that happens, then the trade idea that we're about to walk through will likely lose, which means that the capital that we put out there, we definitely want to make sure it's first of all, within our risk tolerance, also on the smaller side of our risk tolerance. That way, if it doesn't work out, it's not going to blow out the account, right? It's not going to cause too much of a hit. But if it does follow through, then it can allow for a really nice profit. So knowing that, let's kind of take a look at prior earnings to see how NVDA has reacted in the past. Now, last earnings, we had a huge gap to the upside, right? And a follow through with a trend higher, short term and longer term. So that certainly worked out with the volatility move there. Here, we also had another gap to the upside, not as necessarily dramatic, but still a nice gap volatile move. And then it kind of stalled there before it continued the run. And then on this earnings, right, the earnings of last year, a bit more of a non-event, right? This one had a little bit of a follow through, a stair step down, if you will, after the announcement happened. You were running up into it, and then it gapped a little bit lower and trended down, but not necessarily what I would call a strong volatile move that occurred. So did get a little bit of movement, but want to be mindful of that when we're pricing out what we're looking for within the anticipated range. And then this earnings announcement, it was pretty much flat, right? You had a little bit of volatility to the upside, it followed through to the downside. So depending on your strikes and the levels, you might have gotten a quick profit on one or both sides of a volatile move there. But the iron fly certainly would have worked in your favor as well, because any sort of move back into this range, that theta decay would have ripped out of the trade and would have allowed for a profit. So, like I said, I'm looking to play this a bit more on the volatile side of things. But before we do that, let's go ahead and price out what it looks like if we think it's going to be a non event, right? So, for those of you who are like, Allison, I think you're crazy. I don't think this is going to get a big move whatsoever. I think earnings is already priced in and it's going to stay relatively flat. Well, then what you might consider doing is an iron fly, right? Something that benefits from a more non event reaction and from the theta decay getting ripped out of these strikes. Because remember, as we go into earnings, what happens, especially with the expiration that encompasses the earnings. So in this case, this weekly expiration here, What happens with the options is they usually actually hold up on premium really well. You don't get that theta decay that you would normally see on a normal expiration week like this if earnings wasn't around. You don't get that normal theta decay going into the end of the week. It actually holds on to that theta. And if anything, it sometimes even builds up the theta, right? It builds up that extrinsic value, meaning the options are getting more expensive going into the announcement. And that's due to the uncertainty around the news, right? Due to that possibility of getting a volatile move. And so, what the market makers do is they'll keep the price on these out of the money strikes, and then the money strikes kind of propped up some. And then, once the event occurs, right? Once earnings happens, then depending on the market reaction, anything that is remaining out of the money or even sometimes at the money, right, with those strikes, their theta that was really getting propped and held on to completely rips out of it, right? It decays away. So if we don't get a volatile event and it remains flat, it means a lot of this option premium that we currently see is not going to be there anymore. And so an iron fly actually really benefits from that possibility, right? Because if you're selling at the money, you buy further out, and it's basically a put debit spread and a call credit spread. The idea is if it's a non-event, a lot of this theta, right, a lot of this credit that you receive should start to get wiped out, especially going into Friday, and allow you a quick win. So normally, if I'm looking to do an iron fly trade idea through an earnings announcement, what I personally would like to do is I go at the money with the short strike. So we're right by 44.65. You can see that level holds a bit more open interest compared to the strikes around it. So that seems like a good place to start with. And it's a 45, basically a 46 anticipated range. So let's just, to make sure we get the math correct, let's pull out our handy dandy calculator here and say, okay, we're anticipating a 46-point move potentially to the upside, which would put us around 511. Right? So let's just call it 510 in this case. And then we would anticipate a 46-point move to the downside, which should put us right around 420. So let's hope this is the same spread width. I think it is. And so yeah, so that's the risk versus reward. So how many point spread width is this? So 420 minus the 465 strike is a 45-point range. And then we have a 45-point range to the upside too, right? 510, oops, 510 minus 465 is 45 points, right? So even spread width on both sides. And so you can see here the credit that you're receiving is 3165. Pretty good, premium to bring in, right? The idea is basically with this kind of premium, you could move up or down roughly 30 points and, up or down, right? And still be at around break even, if not profitable on this iron fly. Obviously, if it stays flat here, then that's only going to work out more in your favor. If it exceeds that level, right? Then you have to be okay with the risk on this trade. And the risk is 1335. So it's the 45-point spread width minus the 3160 of credit, right? Let's just call it 3150 for easy math. So we get filled at 3150, and that leaves a 1350 risk. Now, for those of us in smaller accounts, that kind of seems a bit excessive, right? That it would cost a bigger chunk of capital if you're trading like in a $5,000 account. No way would I personally do that for an earnings trade. So if you like the possibility of it remaining flat through earnings, but this is outside your risk tolerance, what you could always look to do is one of two things. You could either, one, move out your short strikes, right? So instead of going at the money with your short strikes, you keep your longs within the anticipated range, but then you go out here and maybe do a 5-point credit spread on each side. What this does, it allows much more room for the underlying price to move, right? Anywhere between basically 425 and 505, if as long as the underlying price is at or in between those ranges, you get the credit here of 27 and you walk away for the day, right? The downside is we have a risk of 275. So if it is still a greater than anticipated move, right, then the downside of that is, you have to be okay with that capital risk. Now, that's obviously a lot smaller than the 1350 that we saw on the original Iron Fly. But it also doesn't leave as big of a profit potential. So pros and cons to doing it like that. The other way you could go about this, if you're trading it in a smaller account, but you like the idea that earnings is going to be a bit more of a non-event, is you keep the short strikes still at the same level, right? Still keep them at the money, but you bring in the wings. So instead of doing a 45-point width spread on each side, maybe you do a, I don't know, 20-point width spread on each side. So what that does is, the plus side of that is it still keeps a really great risk versus reward. Notice the risk on this is 270. That's the same risk that we had on the 5-point spread on each side, but it allows for a much bigger profit potential of 1730. Meaning if we were to stay around 465 going into Friday's expiration, this would be the max profit potential we could receive. So excellent risk versus reward. The downside to narrowing the spread width is kind of the same thing that we talked about. If we have a 45-point move up or down and it stays within that anticipated range but hits it either to the upside or downside, well, then we know on a 20-point Iron Fly, we're completely in the money on one side of the spread or other. And that's not what we want, because that means we once again incur that risk of 270. So it just depends what you want. Do you want a higher probability of it working out? If so, and of course you want to keep your risks small. If so, then you might go with the Iron Condor, where you stay 45 points out on each side and just do a 5-point credit spread. Or do you want a bigger bang for your buck, right? Do you want a bigger max profit potential? You really don't think it's going to move the 45 points, that it will stay within the range? And if so, then you might look at narrowing the Iron Fly spread, and really keeping that bigger profit potential as a reward there. And so is there a possibility of a flat move in MVDA? Implied volatility is pretty high. That's part of the reason why I'm looking to trade the volatile move myself. I just wanted to walk through this trade idea first, because I know some people think that it's going to be a bit more of a non-event. But is there a possibility? Yeah, I'd say there's always a possibility. And MVDA, as much as I want to play the volatile move because I like how that looks, we have seen earnings where it's been a non-event, like this one last year, right? The same earnings announcement for the third quarter last year, that was a non-event for MVDA, I would argue. It didn't really see much of a reaction. So if you had done the Iron Fly or the Iron Condor route, at some point going into the end of the week, it would have allowed for a profit, right? And so there's always that possibility. But I do agree. I personally am looking to see a bit more of a volatile move myself, which is why we're going to walk through this next trade idea here to play off the possibility of volatility. And 007, always good to see you. He mentions looking to reduce risk, your profit recycling strategy. You open a call or put debit spread, it goes in your favor. Then you add a credit spread on the other side to turn into a butterfly. So you lock in a profit on at least one half of it. You usually hold it into end of day, but you can day trade out of it for a higher successive chance if you can, in my understanding. Yeah, so that's a part of it. There's a lot of different ways you can profit recycle, but you do have what I would say is my most common way of doing it, which is you start with a debit spread. You add on a credit spread when it moves in your favor. As long as the premium on the credit spread is greater than what you paid on the debit spread, then you cover the risk, you lock in an overall profit. And then, like you mentioned, if it's on something like SPX or NDX where it's a cash settled index, you could technically just let it go, especially if you're in a smaller account, right? That's how you avoid the pattern day trading rule and getting hit with it. But if you're in an account that's above 25,000, absolutely, you can day trade out of it for that guaranteed bonus profit and walk away if you want to. But that is one way certainly to go about profit recycling. Absolutely. And then Papillion's mentioning on MVDA, the market maker is plus or minus 47. No way MVDA stays flat, Small Talker mentions, and the move will be more than 30. It seems like we're all in agreement, but as we know, the market makers like to be equal opportunity dream killers, guys. So once again, there's always the possibility that that's not going to happen, which is why no matter what, for this trade idea, stay within your risk tolerance. So if that 45-point iron fly is what you think is going to happen, but $13 is outside your risk tolerance, then look to take one of the other two scenarios we walked through, right? Either do the iron condor with the 5-point width spread, so you're still out 45 points on each side, or do a smaller width iron fly, right? And there are pros and cons to both of that. But let's walk through, because it seems like a lot of you guys are kind of with me. Let's walk through the possibility of a bigger move. And Anel, there might not be a lot of people on YouTube currently watching me, but I am streaming on Twitch as well as over in the Simpler Essentials room, which does have other people listening. So sorry if it's a little lonely on the YouTube side of things. And Daniel, great to see you over there. Quite a move on the indices today. I certainly agree with you on that. It's been a nice bounce to the upside. And if you caught the start of my session, basically my question is, can we hold up here, or do we break back below basically 44.22, 44.21? Because if we break back below that into the close and close below that level, then that means the 10-period simple on the daily chart for SPX in particular is still holding resistance, which, would still be a little bit of caution. And then Hulagram, not lonely on Twitch. Yeah, no, it seems like there are a few people over there on the Twitch side as well, which is always good to see you guys. But let's go back to MVDA now and let's walk through a volatile trade idea, right? So usually if I'm looking to play a volatile move off earnings, like I mentioned at the start, I want to play both sides because I do not have the inside scoop on MVDA, right? I don't have anybody that works there. This isn't billions. I don't, I'm not unsure. I have no idea, right? I don't know what's going to happen around this announcement. More importantly, I don't know how the market is going to react to the announcement. And so when I think that it's going to have a volatile move, which, like I said, it seems like a lot of you guys are in the same boat as me, then what I like to do is I play both sides. I play the call side and the put side. That way I don't have to be right on a specific direction. All I have to be right on is that possibility of volatility itself. And so the way I like to do that, especially on something like MVDA, which has a higher underlying price here in the 400 level, is I still take into consideration the anticipated range of 45 points, but instead of doing an iron fly that's really wide and that's where my wings are, instead I look at doing two broken wing butterflies, and specifically where the debit spread is wider than the credit spread. And I go out roughly 45 points for the pin. So let's look at doing it like that. Arguably, maybe let's bring it in a little bit. Let's start with 500. So we're a little bit inside, and we'll see how the pricing looks at that. And let's start with a 10-5 butterfly, right? We can always reduce it if it looks like too much on the risk. And this is, I can already tell on the pricing, it's a little bit more than I'd want to pay. So let's do maybe a 5, 2.5. Oh, that's definitely reasonable. Okay, so let's start here. So $500, that's right shy of a 45-point move higher, right? 45 would be at 510 for the pin, but 500 is such a big psychological level that I wouldn't mind trying to put my pin in that range. So this is about and it has a lot of open interest there too, of course. And so right now, let's just call it 80 cents, right? 80 cents is the fill on this. So the idea on a debit broken wing butterfly is the debit spread, right, side of the butterfly is wider than the credit spread. Now, there are a lot of benefits to doing this style strategy. The plus side is obviously you can see doing a 2.5 width spread, it's rather inexpensive, right? It's about an 75 cent cost basis. You have a 425, 420 max profit potential if you close here right at the pin. Not a bad risk versus reward. The benefit, however, of doing a broken wing butterfly over a standard, right? A standard's obviously much cheaper, but the downside is on a standard, you need the underlying price to stay within your wings, right? Kind of like an iron fly. You need it to be above 495, but below 505 for this butterfly to have some sort of value, let alone a profit. Whereas with a debit broken wing butterfly, this strategy, though it does cost a little bit more than a standard butterfly, is still cheaper than doing a pure vertical spread, right? A vertical spread in this case would be $1.42. So it definitely reduces the risk in that sense. But it gives you the forgiveness factor of it completely going in the money. So if we get a strong volatile move, and let's say it acts like SMCI, or let's say it acts like Dick's Sporting Goods, and all of a sudden, this thing has, or it did like last time, right? Where it gapped up almost 100 points higher. Well, if that happens and our debit broken wing butterfly goes completely in the money, it still allows for a profit potential. And the reason is because of the difference of spread width. The intrinsic value on the debit spread side of this trade would be worth $5. Now, on the flip side of that, we would still end up losing $2.50 because obviously you don't want a credit spread to go in the money. But the benefit here is our credit spread width is only $2.50. So when you take into consideration the $5 of value on the debit spread versus the $2.50 of loss on the credit spread, it still equals $2.50. Meaning if this spread goes completely in the money, it still has a value of $2.50. Well, that based off of what we paid at, let's say 75 cents at this point, right, would still allow for an overall profit. But remember, right, we don't know which way this will go. So let's go ahead and also price out something on the put side. So on the put side, a 45-point move lower put us right around the 420 level. That also has a lot of open interest. So in this case, let's just stick within that range. We'll obviously do the same spread width. So 5 points on the debit spread, 2.5 width on the credit spread, and that's about 60 cents. So of course, we have to take into consideration the cost on both sides, right? So 60 cents for the one side plus the 75-cent cost basis of the other side means we're paying about $1.35 total for this trade idea. So what happens? Well, if we have a dramatic move and we're right at the pin, either on the call or put side, that would be a $5 spread with value minus the 135. So that means our max profit potential is 365. Not a bad risk versus reward, right? If I'm risking a total of $1.35 and I get the pin, that's well over 100% return. More than happy with that. But let's say it goes completely in the money, right? Let's say it's that bigger than anticipated move. Let's say this drops. And to the downside, 420 I don't think is a bad level because that's right by where, it's still within the second deviation Bollinger Band. It's still above the ATR trailing stop, which is at 400. So we don't actually need a huge move like this in order for these trade ideas to be profitable. So that being said, let's say one side goes completely in the money. Let's say it falls, right? And we fall down to 400 and that's where we start to stall. Well, once again, we know with a debit broken wing butterfly like this, the value of it completely in the money is 250. 250 minus, of course, our cost basis. Always have to take that into consideration of $1.35 still leaves us $1.15 profit potential, just shy of 100% return. So I actually really like that. That's not a bad risk versus reward at all. It stays within the anticipated range, or on the call side, slightly inside the anticipated range, right, of the move that could occur. Meaning that if we stay within the implied volatile move of 45 points, we know that we're on the call or put side, right? Bullish or bearish. We know we walk away with a profit. And if it's a greater than anticipated move, like we've seen off the last earnings for NVDA, we still walk away with a profit, right? And so that's one way you could play it for a volatile move. Now, let's say NVDA doesn't move, or let's say it kind of moves, but it doesn't get to our strike level. Then once again, you have to be okay with that 135 of risk, right? You have to be okay with potentially losing this amount of money if it doesn't work out in our favor. So keep that in mind. But personally, I kind of like this trade idea here. I like the risk versus reward on it. Of course, if you want a bigger profit target, like I said, you could always widen the spread. Actually, that didn't add too much value. A 7.55 point width spread. The spread width difference is still 250. So if it went completely in the money, it's still a 250 cost basis. But it obviously increases our max profit potential by quite a bit, right? So maybe that's what I'll look at here later today. I usually don't put on this trade until a little bit closer into market close. The downside is sometimes it does cost me a bit more because once again, those premiums can build up going into the announcement on the options. But the benefit of this is, let's say NVDA drops 20 points going into the close today. Well, now I can place my strikes in accordance of where the closing price is basically going into the news event. So I'm a little bit more equal on that anticipated range, right? I'm a little bit more priced accordingly to that compared to putting it on now and then maybe having to sit through another 10 to 20 point move like we've seen today and it, being slightly off balanced on one side or the other. And then, does it take more buying power to do a broken wing butterfly? No, it just depends on how wide. So it looks like I answered your question. Happy to do so. But yeah, it all depends on how wide of a, broken wing butterfly you're doing, as well as what the difference of spread width is. So let's say we did a 7.5 width spread here, but instead of 5 points on the credit spread, we did 2.5. Well, obviously, that's going to increase the cost of it some because you're not getting as much premium on the credit spread to offset the cost of the debit spread. So that's going to make it a little bit more expensive. Whereas the 2.5 width or the, 7.5 width spread on the debit spread versus the 5-point credit spread, that has more premium built into it, so it reduces the overall cost. But no matter what, guys, no matter what kind of spread width you do on the debit broken wing butterfly, there are two things that I would do personally. The first thing is I would keep it a debit broken wing, right? I want to have that flexibility so that way if it's like 100-point move one direction or another, right, a huge bounce either way, and it goes in the money of one of the two spreads, then it's profitable, right? That's the first thing I want to make sure of. I don't want to do a standard butterfly for this strategy. The second thing, though, you want to be mindful of is if you're playing both sides like I am, make sure that the total net debit of both trades still will allow for profit if it goes completely in the money. For example, on this 10-5 with spread, it's $1.40 on the one side, which actually isn't too bad. And on the call side, I know I was playing 500, but let's go with the actual 45-point range, do 510 for the pin, do a 10-5 butterfly. There it's $1.40, right? So the total net cost basis is 280 for both of those spreads. Well, as long as the total cost of 280 is less than the difference of spread width, which in this case 10 minus 5 is 5. So we know if it goes completely in the money on one side or the other, the value of that butterfly will be $5. So as long as, the net debit that I'm paying for both butterflies is less than 5, I know that there's a profit potential if it goes completely in the money. Let's say for whatever reason, I jumped into this trade idea, but I paid $6, right? I paid $3 for each butterfly. Well, then that doesn't make sense, right? Because if it goes completely in the money, I'm still out $1 on the trade. So whenever you do debit broken wing butterflies where you're playing both sides of the market and you're playing more off the idea of volatility rather than a directional move, you just want to make sure that the combined cost basis, right, the combined risk that you have out there on both trades is still less than the difference of spread width. That way, if you have to use that forgiveness factor of one side of the butterfly or the other going completely in the money, you know that you'll still be able to walk away with a profit. So for example, in the 10-5 butterflies we priced out just now, if both get filled at $1.40, we pay $2.80 total. that still allows for a 220 profit potential if it goes completely in the money. So I hope that helps y'all out. Let me catch up over here in the Simpler Essentials room and see. So, and then 007, using that strategy is basically how you took your account. Yes. So if you're referring back to the profit recycling strategy 007, that is exactly how I grew that a 10K account up to 43K that one time. Because I couldn't day trade it, at least, up to a certain point, I couldn't day trade it. But I did, instead of doing debit spreads and converting them into butterflies, a lot more often when growing the account that time, I actually did long calls and puts, and then I profit recycled into verticals, or I profit recycled straight into butterflies from there. Most of the time I actually profit recycled into verticals though. So like I said, there are a lot of different ways to profit recycle. It's just about using that option chain and the intraday charts to your advantage on those moves. So I hope that kind of helps you out. But yes, profit recycling is exactly how I grew that account, and all without technically using day trades. And then Marco's asking, what about an inverse iron condor? So if just so I understand Marco correctly, you're looking and saying, what if we did 2 at the money debit spreads instead of credit spreads, right? So it looks something like this, if you will. You could do that, but it's going to cost you money. In short, right? How many points did I do on this side? Let's just say we do 10 points. So I make it easy for myself. So you can see the downside to that is you're paying a lot, right? It's a 925 risk, and it's only a 70-cent profit potential. And that's once again because of all the premium built up. That's why if I'm doing a directional trade around earnings, unless it's on something that's priced really low, like BMY, where the at the money strikes are still rather cheap, which keep in mind this doesn't have earnings, but let's say it did, right? The at the money strikes are a lot cheaper, so it's easier for me to jump in with a long call and long put at the money and play for the directional move on this and stay within my risk tolerance than it is versus MBDA. And second of all, this is not a risk versus reward scenario I would ever participate in. There's no way I'm risking $930 to just try and make 70. There are much better strategies to go about doing that. So I hope that kind of answers your question, which is part of the reason why for the volatile trade idea I'm looking at, I go further out of the money to keep that risk low, but I still try and stay within the anticipated range. That way, if all it does is move up or down the 45 points, which is what the market makers have already priced out for us, then I still, can get a very nice profit if it's off the pin. And then if it's greater than that, I have that forgiveness factor of a profit by using the debit broken wing strategy. And then 007, you usually do these trades for the close? No. So profit recycling, especially when I was growing that account before, it all just depended on the intraday chart. So a lot of the times I'd actually look at trades in the morning, and sometimes into the close. Sometimes they were actually overnight trades where I would jump into a long call or put, hold it over for the overnight move, and then profit recycle it. So there wasn't necessarily a specific time of day that I use that strategy. It's not like the SPX lotto pin strategy where that solely is something I look at into the close. It all just depends on if there's a setup, right? It's more setup dependent on the chart itself. And Marco, not a problem. Happy to answer the question. Of course, 007, always happy to help out, guys. So yeah, that's kind of the earnings trade I like, is either doing, I don't know if I want to do the 10-5 personally because I want to keep my risk on the smaller side, but either the 7.5 5-point width spread or the 5 2.5 width spread. I did not mind the pricing of that. So that's probably what I'm going to look at into the close, is some variation of this. Or maybe, like I said, the 7.5 width spread, 5, because that allows for a much better max profit potential. And I'll probably look to trade that in the small account mentorship going into the earnings tomorrow. And we'll see if that volatility works in our favor or not on the announcement itself. Yeah. So for the call side, um, you can so Enrique, if you want to do the 10-5 butterfly, then yeah, personally I would do 500 as the wing just to keep the basically when I do a 10-5 butterfly and I'm doing both a call and put broken wing butterfly, I personally like to keep my costs less than $3. So to keep it less than $3, right? You have the correct strikes. I'd be looking at the 500, 510, 515 for the call side because that's right within the anticipated range. And at least the long strike still is at 500. So if all we do is tag 500 and stall, that should still allow for a profit based on my experience using the strategy and how the theta and stuff works and everything. And then on the put side, I would do 420 for the pen, 430 for the wing on the debit spread, and 415 for the wing on the credit spread. And that's about $1.40. And that too is right within that 45 point anticipated range. So if you're looking at the 10-5 scenario and you're okay with that, basically that 280-ish of risk. And like I said, I personally wouldn't try and pay more than $3 for both sides. So if you're in one side and all of a sudden the market makers are causing this to increase in value, you could always go like one strike set lower to stay within that risk tolerance. But personally, I wouldn't pay more than $3 for both of those butterflies. Of course, of course. And then Len's asking, what do I think of NSSC? Yeah, let's take a look at it. And then Marco, I'm not going to post it in the alert section only because I haven't opened the trade yet, so I don't want to confuse anybody about what I'm jumping into. We will though, Marco, in the small account mentorship, I am planning to open this today into the close. So that account, once we do open the trade, I'll do it live on the mic with you guys. Then we'll definitely get an alert sent out there. But in the chat really quickly, right? If you wanted to look at that, I'm happy to post in the chat what I was looking at. So it was the if you're doing like the 7.5 5-point width spread, then it's the 42.50, 420, 415. Put strikes for a put debit broken wing, and then the call side. I was doing, and I still haven't decided what spread width I want to do, but I'm definitely leaning towards either the 7.55 or the 2.5 myself. And if I was to do that over here, let's just see what the cost of this is really quickly. I'd probably go slightly off of that. So maybe something like this, just because of the two cost basis, you want to try and, like I said, make it so that if it goes in the money, there's still a decent profit potential there. So maybe something like the 497.50, 505, 510 on the call side. The debit broken wing. Sorry for the typos. And so Marco, on this trade idea, yes, if it either goes flat or we get a move, but it is not, right? Let's say it's only a 20-point move instead of a 45-point move, then this trade will lose. We need it to move at least within that anticipated range of 45 points up or down, or greater than that for this to be profitable. So if it's flat or if it moves but not enough, then we might be able to recoup some capital if it at least moves a little bit. But I would anticipate a full loss if that happens, right? You have to go into the trade with that mindset of this is earnings, anything can happen. I have to be okay with that risk out there, which is why I'm looking at the smaller width spreads myself, right? I want to keep that risk closer to around a dollar if I can, or under $2. So that way, it doesn't really hurt the account if it doesn't work, but if it does, it allows for some nice profit potential there. And then let's go back to NSSC really quickly. Oh, that had a huge move lower. Was this off of earnings? I get why you're looking at the bullish sentiment. It says earnings was anticipated to be the 28th, but I'm a little curious if they had something released prior. That's usually what, like they basically have some news or they come out being like, don't expect much from earnings, right? It's usually something like that to have this big of a gap move if earnings is still a little bit ahead of what's happening here. But I get why you're looking bullish, right? We had broken the ATR trailing stop. We did a good job of holding the 100. We were trying to go into that bullish trend here. Momentum was bullish. This was a bullish signal. You had a squeeze. And then this just gap to the downside. It made a strong third deviation Bollinger Band snap. So that's a good clue that the price will either stay within this bars range or continue lower. You can see the next day we basically stayed within this range. Today we moved a little bit higher, but we're not really getting a strong bounce or reversal trying to recoup this gap, at least not at the moment. So if anything, we filled the gap that we made off the last earnings completely. Momentum's bearish. This, of course, immediately turned bearish. The squeeze fired to the downside. So my guess is some news, because I don't pay attention to this company necessarily, but I'm guessing some news caused this to happen early before the actual earnings, which is unfortunate. And then Lynn's saying it could drop because it has earnings September before. Yeah, I'm a little shocked about it. Oh, allegedly they cooked the books. Well, that's definitely that could definitely cause a move like this. Typically when a move like this happens, whether it's around earnings or it's, just an event of news that comes out that, the market clearly didn't want to hear, I usually go to a longer time frame and see if there's any support or resistance level nearby to try and help us out with that. So I do have to go here soon, but let's take a look at this before I do. And then Marco, for the earnings trade, if it goes flat, I typically don't do anything. I don't try and like revenge trade or anything like that. It's either going to work or it's not, kind of thing. So if you're already concerned about it, right? Because like I said, earnings trade should be treated a little bit more like a lotto trade, meaning you put the money out there, and if it doesn't work, you're okay losing it, right? You're not necessarily anticipating it to work, but it still has, a better probability than maybe playing the Powerball, certainly, right? But you put that money out there with the idea that it may not work, and that's okay if it doesn't work, is how you should treat an earnings trade. So back over here to NSSC weekly chart, we've completely blown past the 100. It is trying to get a reversal, but even here, strong third deviation Bollinger Band snap. And I mean, once again, everything about this chart was bullish until that news came out. And this is, I guess, another good example of just like an earnings trade. Really, any trade that you put out there, guys, from my perspective, I am okay losing 100% of the capital for exactly this kind of situation, right? Because the technicals can be going in your favor and everything else. And all it takes is one story to come out, something like that, to completely change the market narrative and have it, reverse course, if you will. So by going out there and always putting out the amount of risk that you're willing to lose, it keeps you from, first of all, blowing out an account, right? Because you're not investing the full account. It should only be a small portion of it. And two, it helps protect your account from moves like this. So that way you always have capital to jump back in the game with, because, you didn't put it all on NSSC to play for a bullish move. Now, there are a couple of clues on why we could have moved lower, right? And this actually started to show up last week, interestingly enough. Notice how we started to reach monthly exhaustion, right? So monthly exhaustion started to peak in last week. Now, obviously, things could have continued a little bit bullish, but you can see here the Bollinger Bands have started to flatten out. You started to see exhaustion levels for bullish momentum. And then, of course, this week we're getting a pullback signal, which makes sense because of the downturn. But I guess there were a couple of clues on a longer time frame to kind of be cautious about how much higher this could go. Still probably wouldn't have anticipated this big of a drop, but that's, the reaction that we're getting. What I would look for into the close of the month is, does it hold 25? AKA, does it hold the 30 period simple, which is technically at 24.94? If we can bounce a little bit and hold that level, then we might actually be trying to find a buy-in spot. And you still might give it a little bit of time to confirm it's holding, but you can see the last few pullbacks that we've had towards the 30, it's done a pretty good job of holding that range and actually creating a buy-in opportunity to play for a bigger picture move to the upside. Now, of course, if the news that came out around this is that they cooked the books, you still might be cautious about how much money you're buying in with if you're doing shares or a leap or anything like that. Only because that's the kind of news that will certainly, at least I speak for myself, it would certainly have me speculating like, okay, well, how trustworthy is this company for me to put my money into it, right? Can I really assume that the books are going to be proper from here on out, and go about it like that? And then, Tommy, the $500 challenge account, we're still doing those trades. I haven't put on one recently, but I do still put those on. They are in the Mumu account currently for where I do that. So be on the lookout for it, and certainly join me on Monday, and we'll give an update in the Monday session to review that. But unfortunately, I'm a little over my time, so I do have to go, guys. Thank you so much for joining me. I hope this, gave you some information on ways to trade earnings announcements with MVDA as an example. Gave you a thought process for what I'm looking for on the markets to see, whether we kind of stay within this chop or move up or down, right, depending on the close of the day. And gave you some insight, of course, on NSSC, what to look for there when you have bigger moves. As always, though, may the trade be with you, my fellow Jedis, and I look forward to talking to you next time. Bye, guys.